Welcome to Investors Guide. You're watching ET Now. Thank you so much for joining us. On this show, of course, as always, we're going to try and find the perfect investment portfolio for you. This is your one-stop guide to all your questions about money. Our email ID is at the bottom of your screen, where you can send in any question you have about saving, about investing, or even about spending your money. Over the next half hour, we'll start by telling you what part of the interim budget announcement that happened earlier this week will actually affect your pocket. We'll review the Birla Sun Life Dividend Yield Plus plan, and we'll find out if you should, in fact, stay invested in that plan. And finally, we'll tell you what discounts banks are offering on home loan interest. That's coming up later on the show. All right, so the interim budget was presented by the Finance Minister earlier this week, and we all know about that. And even though you might have thought that it was a non-event, there were some important announcements that will impact your money, especially if you're a retired serviceman from one of the armed forces. And I know we have a lot of viewers who are. Take a look at the big announcements that impact our money from the interim budget.
Food inflation declined sharply from a high of 13.6% to 6.2%.
As expected, the interim budget did not have any significant tax-related measures, but it did have some good news for students. The Finance Minister has proposed an interest rate holiday on student loans, wherein the students will be excused from paying interest on education loans which have been taken before 31st March 2009. Loans outstanding as of December 31st, 2013 will be eligible for this benefit. The borrower can avail the scheme only once. The scheme will be implemented through Canara Bank and is expected to benefit 9 lakh students. The interim budget had something for the retired personnel from Defence Forces as well. The long-standing demand of servicemen for one rank, one pension was finally accepted this budget. This means that the retired soldiers of the same rank and length of service will receive the same amount of pension regardless of which year they retired in. Currently, pensioners who retired before 2006 draw less pension than their counterparts and even their juniors. There were plenty of sobs to boost the ailing manufacturing sector. Excise duty cuts were announced for small cars, scooters, motorcycles and commercial vehicles. The excise duty on these vehicles was cut by 4%. SUVs will also cost less, with excise duty being cut by 6%. Excise duty on large cars will now be 24% compared to 27% earlier, while the duty on mid-size cars will go down to 20% from 24% previously. Your home and kitchen appliances like microwave ovens and televisions are going to get cheaper. As well, with excise duty being cut on consumer durables from 12% to 10%. And for those of you who are planning to buy that new phone, there is reason to cheer as well, with the excise duty on mobile handsets being reduced to 6%.
All right, so one of these things that I think was really important, and to discuss that, of course, I'm going to bring in Dhirendra Kumar, the CEO of Value Research, who joins us every week. Dhirendra, thank you so much for joining us. We were just looking at the list of announcements that impact us directly from the interim budget, and the most interesting to me is that one investment account, and that should possibly make a lot of things easier for regular investors. Do you see this as a very big move from the government?
Yes, I see it as a very significant move. But, you know, the government has very little to do with it. Government is more likely to be an enabler because it has more to do with, you know, different regulators, IRDA, SEBI, and, you know, banks collaborating to present you an investment account. We come across, you know, so many investors who have invested over a long period of time through their lifetime. And many of their investments are either inaccessible, they can't access it when they need it most, or they simply lose track, and tracking it becomes very problematic. So if this becomes mandatory, maybe, you know, in 5-10 years from now, it will become the mainstream way, and it will be quite a revolutionary thing for investors.
Well, Dhirendra, obviously this is a big announcement, but let's keep in mind the fact that we're going to see a new government in another couple of months, and a lot of times we hear things being announced in the budget or in the interim budget, as in this case is, but by the time we actually see it implemented, several years go by. How long do you think it's going to be for the government to actually implement this idea?
It's entirely a function of whom this project is entrusted. As I said, you know, this will require making various systems, various I don't think there will be a regulatory glitch And I don't think there will be too much of a legal issue here. But operationalizing it, making things happen, it's entirely a matter of, the commitment of the leader who is assigned this task.
All right, so it is a big task, but of course, when it does happen, it will make things much easier for us as investors. If you have any questions about the interim budget, write to us. Email ID is at the bottom of your screen. All right, let's get to work for this week. It's time for our portfolio versus portfolio question. Well, Nishant has written in, 38 years old. He tells us he has about 35,000 rupees at the end of every month that he'd like to invest. His goal is a retirement corpus for himself. He wants to buy a car in a few years, and he wants to buy a home in Chandigarh in 3 or 4 years. Now, he tells us he has 40,000 rupees in his public provident fund. He has a little over 1 lakh rupees in his own employee provident fund, and 1 lakh rupees in his recurring deposit. Now, he doesn't have any health cover, Dhirendra, and he had a bad experience while trading in the stock market, so he stopped all of that, the trading that he used to do. He now has 80,000 rupees going into the Jeevan Anand, the ICICI Prudential Life Stage Pension. There's a whole life plan and a guaranteed savings plan, all from ICICI Prudential. He wants to know if he should continue with these investments. Let's start at the first thing. No health insurance, and his life insurance seems to be all over the place. Would you like him to first take stock of his insurance policies?
The endowment plan or, the LIC Jeevan Anand, at best, it will give him a return. Of course, there is a mortality benefit, but it's not meaningful enough. That apart, the best return that he can expect is what he gets in his savings bank account. That is what it has historically given. So I would say his selection of the traditional policy, because his experience in stock market was bad, so he got into even worse investment. I think he needs to really review his investment premium going in and possibly discontinue all of it methodically. Certainly go for a term cover, health cover, and divert all this money into one of our portfolios, and that's all that he should be doing.
Which of our portfolios, Dhirendra, would you like him to be using at this point?
Given that, he gets upset when he sees a decline of any meaningful kind, I would say that for him, even though he has a lot of time on his side, he should go for our stable growth portfolio, because this will ensure that he will, and after running it for 1 or 2 years, he'll be able to participate in any market rise, and the market, the portfolio will not tank on a big market decline. So that will help him, restore faith.
All right, so there you have it. That's the advice that Dhirendra is giving you. Simplify your investment policy. And of course, write back to us if you need anything else. I'm going to take one very quick question. Vikram Rajput has written in from Dubai. He wants to invest 25,000 rupees every month in Indian mutual funds for the next 15 to 20 years. His aims are to create a retirement corpus for himself and for his children's education in the future. He sent us a list of funds that he shortlisted, Dhirendra. He sent us 25 funds that he might invest in. Most of them are large cap, some of them are multi-cap. There are some specific funds that invest in FMCG and pharma. I'm not going to go through that list. It's too long and obviously too complicated. He shouldn't be investing in 25 funds. Can you give him a more simplified process that he can use?
No, one is that, he has just the appropriate time frame for equity investments to fructify. And he should certainly keep it simple. One thing I would just like to emphasize, that having 25 funds will effectively nullify the need. If he has to buy these, if he is really convinced about these 25 funds, I think he'll be better off by buying 2 index funds. If he puts all his money in a Nifty fund, a Nifty index and a junior Nifty, he just might be better off. 3-4 ways of going about it. If he's an aggressive investor, he should, and he can withstand great volatility, go for our aggressive growth portfolio without the fixed income allocation, or go for our growth portfolio or stable growth portfolio. Stable growth portfolio will be far less volatile, and it will also not be it'll be relatively lower yield, lower return on a 15-year time scale.
All right, so our aggressive growth portfolio, given your time frame, is on your screen right now. If you want any more information, feel free to write to us. Our email ID is at the bottom of your screen. Now, before we go into break, there's an interesting movement that's happened in our banking sector. Several banks are offering discounts, or they have offers on home loans right now, especially if you're a woman. Take a look at all of the offers that are available in the market right now if you're looking to buy a home.
Over the last decade, Indian women have moved into the driver's seat. Research tells us that a number of women co-signing as applicants for home loans has risen exponentially, and banks are thrilled to encourage more women to buy homes. So if you are a woman looking to buy your dream home, here's a list of some offers available in the market, with the only condition being you have to be the main applicant to the loan, and if it's a joint ownership, you should be the first owner. ICICI Bank offers an interest rate of 10.20% for a loan above 25 lakh, which is 0.15% less than the usual market rate. SBI offers an interest rate up to 10.10% for a loan up to 75 lakh and 10.25% for a loan above 75 lakh. That's a discount of 0.05%. The Indian Overseas Bank offers an interest rate of 10.25% for a loan above 75 lakh, which is 0.25% lower than the regular rate. And LIC HFL has recently come up with a Super Choice Festival offer with fixed interest rates for 2 years, which will vary from 10.6 to 11.1%, and a new fixed 10 scheme with fixed interest rates for 10 years, which may vary from 11.5 to 12%. The scheme is available for both men and women.
All right, time for a quick break. On the other side, Dhirendra Kumar is going to stay with us. We'll review the Birla Sun Life Dividend Yield Plus plan. Don't go anywhere. Welcome back. You're watching Investors Guide on ET now. Thank you for staying with us. It's time for our product review. And this week, we're reviewing the Birla Sun Life Dividend Yield Plus fan. Avan is here to give us a quick introduction. Avan.
Thanks for that, Faye. Well, the fund in focus this week had quite a checkered track record. It shot into the limelight post the downturn of 2008. At a time when most equity funds were having trouble keeping their head above water, these funds surprised investors by not only tiding through the volatility, but by also giving its investors a return of nearly 90% in 2009. In 2010, it ranked 7th amongst its category. Post-2011, the fund began to slip. Its mandate to pick high dividend stocks has resulted in a rough couple of years. The fund has lost 4% in the last year and has fallen to 104 out of 110 funds in its category, which resulted in a downgrading from 5 to 2 stars. So let's do some math to get you a better point of view. If you invested 1,000 rupees in this fund when it launched, you would have 8,747 rupees today. So despite the fund falling from its rating, should it be a part of your portfolio, or is it time to pull your money out? Our experts are here to give you the answer. With that, it's back to you, Faye.
All right, Avan, thank you for that introduction. Dhirendra, Birla Sun Life Dividend Yield Plus is a fund that did a marvelous job of managing the volatility between 2008 and 2011. In fact, its rating went up by 3 stars over that period. You personally gave it 5 stars when we reviewed it in July 2012. Today on Value Research, that rating has come back down to 2 stars. Tell us what happened with this fund. And for those investors who are holding it based on your previous recommendation, should they be pulling their money out?
First and foremost, investors should not be pulling their money out. I'll tell you why it has not done well, and also why it should not be written off. One is that these funds, all the dividend yield funds, they chase dividend, and which means they invest in a portfolio. They invest in a set of stocks which have superior dividend yield relative to the market, and all these funds follow their mandate very rigorously. These funds, by their design, tend to be in a set of stocks which are out of favor, and if the stocks which are out of favor, or the segment of the market which is out of favor does not get in favor, then these funds will suffer, and that is what I find. But till these funds remain true to their style, which is if they maintain their style purity, if they are not getting distracted, if they are not altering their portfolio to escape this decline, these funds will bounce back.
All right, Dhirendra, finally, give us your rating of the Birla Sun Life Dividend Yield Plus plan on Investors Guide. Where would you place it?
I would still give it a 3-star, which is a notch higher than what the risk-adjusted rating scale is. And broadly speaking, if it is one of the three funds and the other two growth funds that you hold, then it is investor must carry on with their investments in this fund.
All right, 3 stars for the Birla Sun Life dividend yield plan. And of course, Dhirendra, they're saying we need to have a little more faith, give it a little more time. This particular phase of the market has been bad for dividend yield funds, so we'll continue to track it on the show. If you have any questions about that fund, write to us. Email ID is at the bottom of your screen. Let's move on to our hold or sell question. Well, Rahul Mehrotra is the lucky viewer whose portfolio we're going to look at this week. He's 27 years old. He tells us he's been investing in mutual funds to create long-term wealth with a time horizon of 15 to 20 years. He wants to know if his investments are on track, and we always love it when viewers write in and tell us they have a really long-term horizon. I'm going to first take the 2 large-cap funds on his list, the Franklin India Blue Chip and ICICI Prudential Focus Blue Chip. Dhirendra, 1,000 rupees going into each of these funds for a young man, 20 years. Does it make sense?
Yeah, both are excellent large-cap funds. And, these funds have been part of our selection. Whenever we have to recommend a large-cap fund, we recommend these. But for somebody like him, there are different ways of approaching your portfolio. Having a portfolio, filled with, having a set of funds which are flexible, they can change track, and they are not very rigidly or tightly defined, which these 2 funds are. They will always be in large cap. Given his time frame, these are inappropriate investment. At least he should have, large and mid cap funds or multi-cap funds which have internal flexibility to move in all part of the market.
Let's look at these funds then, Dhirendra. This is a multi-cap fund, HDFC Equity, 2,000 rupees every month. He has HDFC Mid-Cap Opportunities and the DSP BlackRock Micro Cap. Now, between HDFC Equity and Mid-Cap Opportunities, does he need to have both of those funds?
No, not really, because if you look at HDFC Equity, nearly 35% overlap with HDFC Mid-Cap Opportunity. So he just has 2 set of funds, but a significant overlap. DSP BlackRock Microcap is a very interesting fund. It remains in smaller companies and fairly high quality small companies. But I find it to be a very impressive portfolio, which will struggle for a long period of time to reward every 4 or 5 years.
Well, the last 2 funds on his list, are the Kotak Bond Fund and the Kotak Gold Fund. Now, does he need to have both of these funds in his portfolio? He will have to have some little bit of debt allocation, but is this the right way to do it?
Your fixed income allocation should be a very strategic allocation in your whole portfolio. If you have pre-decided that 10% or 20% of your portfolio will be in fixed income, it is valuable only if you diligently rebalance your portfolio annually. And about gold, I'm extremely downbeat, and particularly now when the gap in the ETF and the gold fund and the way the pricing and the premium and the custom, so it has become a very complicated and a very risky asset class. So I would say that don't take a punt on gold and have that fixed income allocation in a deliberate way and with a view to rebalance your overall portfolio annually.
So if you have any more questions about your portfolio, write to us. Our email ID is at the bottom of your screen. Dhirendra, thank you so much for joining us this week and answering our questions.
Thank you.
Coming up after the break is our tax corner. We'll tell you if you can claim the deduction on your wife's investments. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. It's time for our tax corner. So we've brought in Suresh Surana, who's going to answer all of your tax questions. Suresh, thank you for joining us.
Thank you.
Now, Ashish writes in, he tells us he has 50 lakh rupees in a bank fixed deposit that gives him an interest of 9% every year. Now, he plans to move overseas this year and he wants to know how his new NRI status will impact the tax treatment of his investment. Suresh, would you recommend he just converts that into an NRO account if he's moving overseas anyways?
So, Faye, in case of Mr. Ashish, whatever interest is earning on the fixed deposit, since it is not an NRE or FCNR deposit which is exempted, in this case it will continue to be taxable in India. And since this is exceeding rupees 2 lakhs, which is the basic exemption limit, it will be subject to tax in India. What he can, perhaps look at is that once he becomes a non-resident, he is allowed to remit up to $1 million outside India. So the entire amount of fixed deposit what he is having right now as and when it matures, he can look at remitting it out of India, and he can bring it back as an NRE or FCNR deposit, in which case that interest income will be exempted from tax. So that is one possibility which he can look at. But if he continues the way it is, then it will be taxable in India.
Rohit writes in, he tells us his wife earns 60,000 rupees every year from tutoring children, and she deposits 40,000 of that money in the Public Provident Fund. That money is meant for their children. He wants to know if he can claim the tax exemption amount against ATC while filing his returns on his wife's investment. Suresh, is that possible?
So, Faye, in the case of Rohit, the deduction under section 80C is only available to the person who is actually contributing. So, in this case, if the wife is contributing to the PPF account of the children, then only she can claim the deduction. However, what can be done is that if Mr. Rohit contributes to the PPF account of the children, and the wife maybe incurs the household and other expenses what today is being incurred by Mr. Rohit, then he will be able to claim deduction in respect of the contribution made to his children's account under the PPF accounts.
Last question. Bhaskar has written in, he is 33 years old and he's invested in 2 tax-saving mutual funds or ELSS. He wants to know what will happen to his tax-saving investments if the direct tax code comes into effect in the next financial year. Well, first of all, Bhaskar, the possibility of that happening right now is very, very slim. It's almost close to nil. But let's ask Suresh. Suresh, should he be worried about the direct tax code at all?
As far as Mr. Bhaskar's question is concerned on the direct tax code, I think at present we are already aware that it will not be introduced in the current parliament session, and therefore it will really depend upon the new government which comes into effect after the elections, and what is their economic agenda and what is their view on the direct tax code. So actually, as of today, I will not really worry about what changes the direct tax code, if at all it comes, what it might bring, and it's really too much uncertain right now what will be the eventual situation on that front. What he really needs to do is to look at the current regulations and basically continue to remain invested or divest depending on the prospects of the investment, rather than worry about the tax consequences.
All right, Suresh, thank you so much for answering our questions. So if you have questions about tax, about home loans, about credit cards, write to us. Our email ID is at the bottom of your screen. Thank you so much for watching Investors Guide this week. You can reach me personally on Twitter. That's on your screen as well. Tune in next week to catch the show. Thanks for watching.